Today's video, I'm going to discuss who should buy an IUL, what is an IUL, how does an IUL work, what are the large negatives with IUL accounts, and then where can it be beneficial for an individual to leverage for their specific situation. So to start off and to really take a step back, understand how any sort of account works. So if an individual is trying to save money, and let's say that they're, just started working or they're close to retirement, whatever that case is, what ultimately is happening is any sort of account grows by the same formula. It grows by the contributions somebody's placing into a plan and then the rate of return that's coming back. So if you have a 401k account through your employer and you're making contributions in there, that's contributing to that account. That's adding dollars into that account. If you're getting matching money, that's still contributing dollars into the account. So that's adding positives into the account. If let's say you have your 401k account that's set up with different investments, well, that's where the rate of return. If the investments have a positive rate of return, you're going to have a positive in the power of compound interest working favorably for your account. If let's say that rate of return comes back negative, it's going to be equivalent to someone taking a sword and slicing your bucket, and you're going to have less dollars. You're going to have a smaller bucket. You could do that with 401k accounts, 403b accounts, IRA accounts, Roth IRA accounts, a savings account. If you think of it as simple as a savings account, an individual is placing monies into savings, that's the contribution, and the rate of return is going to be some sort of fixed rate of return. It might be small, but it's still, this formula is going to apply with any sort of accumulation or any sort of saving strategy. I want you to understand that concept because when somebody's trying to structure an IUL the correct way, they have to always have that in mind. They have to say, okay, if I'm placing dollars into a plan, how can I maximize out the amount of contributions that's going into this bucket, into this benefit? And then how can I also get the highest potential rate of return if I'm leveraging this specific vehicle? So an IUL, simply put, is considered an index universal life insurance policy. It's giving you a life insurance, or the inner components is tailored towards life insurance. But individuals that, let's say, are not eligible for a Roth IRA, or they want to accumulate more savings dollars and they don't want to have a cap on how much they could contribute into some sort of tax-free area, they would utilize a properly structured IUL. And the benefits of it, in theory, now, majority of how these plans are set up, I'd say over 90% of them are set up the wrong way. But in theory, if you set them up the right way, you can have tax-free growth on your monies, think of it like a bucket. You could have tax-free income when it comes time that you want to leverage this for retirement or some sort of ancillary need, some sort of ancillary expense. And then also you could have a tax-free death benefit that be left over to your beneficiaries. In case you were to pass away prematurely or whenever you pass away, you have basically a death benefit that could be left over tax-free based on the amount of assets you have, based upon the amount of assets within your estate. But ultimately, it's giving you those three main factors, which sounds great. You're placing monies aside into an account. The account's growing tax-free. You're able to pull those monies out tax-free. And then also, if you pass away or whenever you pass away, you're going to have a larger death benefit than what your physical account value is. That'll be left over to beneficiaries tax-free. Now, why do I say that they're set up the wrong way, or why you have a lot of problems with these things? Let me explain to you how a typical permanent life insurance policy works, and then how a properly structured IUL works, and then in correlation to how any sort of account grows. So what we have pulled up is, let's say if an individual is trying to place $1,000 into a life insurance policy. What's happening within, or this is just the generic concept, what's happening within the inner workings of that policy is an individual is placing dollars in there, and it's set up for some sort of death benefit. So the insurance company is fixated on that death benefit. They're fixated on that risk. It's known as net amount at risk, because they're saying if somebody's putting $100,000 into a plan and they have a $500,000 death benefit, there's a large difference in there. If that guy gets hit by a bus within a week after he purchased his policy, well, now the insurance company has to pay out $500,000 to their beneficiaries. So it's going to be very expensive. That cost of insurance and other expenses are going to be very large. Now, what happens is after that cost of insurance and other expenses are paid off, you have ultimately a contribution into this cash value component. Think of it like equity that's building up within that policy. So cost of insurance and other expenses. So the dollars that are going in there are eaten up with cost of insurance and other expenses. That's correlated to what the risk is, to the insurance company with the $500,000 death benefit. So if somebody's trying to utilize one of these plans, what makes the most sense? Well, what makes the most sense is to reduce this death benefit, because if you reduce the death benefit, then you're going to reduce the amount of cost in insurance and other expenses so that more dollars could be filtered into that cash value type contribution. So if we use that same sort of example, but now instead of a $500,000 death benefit, this was reduced down to a $200,000 death benefit, what happens? Well, you see less red in there and more dollars are going into the cash value. And what happened was because your net amount at risk was significantly reduced. There was less risk to the insurance company, so therefore there's less costs. Understand this concept. Because if somebody's trying to create a properly structured IUL plan or properly structured cash value maximization strategy, what they're going to want to do is have the lowest net amount at risk possible. They want to make sure that this dollar amount is as low as what the IRS allows to hoard the most amount of dollars in there. So if you ever heard the term MEC or modified endowment contract, that means that there's going to be an actual limitation between how much an individual can shove into one of these policies and the amount of death benefit that's correlated to it. So an individual can't just say, I have $1 million sitting here, let me go shove it into this sort of life insurance policy and only have $1 of death benefit. You cannot do that. It's known as MEC limits. If you do that, it's going to really just cancel off all the real good benefits of this plan. You're going to lose out on all that tax favorability of the tax-free growth and the tax-free income on it. So that's why it's very important if you're trying to set up one of these plans to stay within MEC limits. But ultimately, with the goal in mind is to say, I want to make sure, if I'm thinking of that little bucket scenario, I want to make sure I'm maxing out the most amount of contributions into this cash value, because we know that that cash value, what does it do? It grows tax-free. You can pull your monies out tax-free, and you also have a death benefit that you could leave to beneficiaries tax-free. So by hoarding the most amount of dollars towards this cash value and making it grow in the easiest way possible, that could be beneficial for some sort of retirement play and utilizing this as a retirement asset for a later date. So I hope that all of that makes sense. And ultimately, what's happening with the difference between these different plans is just like that bucket idea, the contributions is what's filtering into this cash value. And then the rate of return that's coming back is based on the type of policy that you're trying to create. So if, let's say, you want to have a fixed type rate of return, that's when individuals would get set up with something called whole life. So you could properly structure it. It doesn't have as much flexibility as an IUL, but this rate of return, you could still do it where you have a minimum death benefit. You're trying to max out the contributions, max out the cash value so that cash value is growing, and then you know that you're getting some sort of fixed rate of return on that. That's for more of the conservative individual that says, I just want to have more of a bird in the hand. I want to make sure that there's always some sort of growth that's coming into my policy, and I want to see those guaranteed values within that policy. These universal life was very popular in the 1980s, and it's because it's tied to interest rates. So that rate of return is tied to the interest rate environment. Well, back in the 80s, they were projecting, or they had double-digit rates of return, and they were projecting that those rates of that interest rate environment was going to stay there. Unfortunately, individuals back in the 80s, early 90s, they underfunded these policies, expecting these large rates of return, but because interest rates went to all-time lows, it basically tilted everything on its head. You had individuals that were minimally funding the policy, expecting these large rates of return, and individuals basically by minimally funding the policies and having a small rate of return, it was blowing these policies up, and they were canceling these policies after they're in force for 10, 20 years. The other type of permanent policy would be if you want to tie this rate of return to some sort of mutual fund or sub-account related aspect. So this is leveraging it towards different investments. So this could be positive or it could be negative. The monies could grow tax-free, pull your monies out tax-free, but you have to be very careful because you have the different mutual fund related fees that are associated with it on top of the cost of insurance and all those other expenses that I was mentioning on the other screen. So that's where variable or VUL policies come in. And then the IUL has been very attractive really since the early 2000s. And the higher that interest rates have climbed, have had a trickle-down effect on how these indexing strategies work. So the way and how this grows is your rate of return is based on an underlying index. If that index is positive for the year, you're going to receive a gain on your anniversary date based on which sort of allocation you chose. If that index comes back negative, you're going to gain 0%. So unlike the VUL, which is going to grow or it's going to go down, the IUL gains or flatlines. So you're never receiving any sort of negative rate of return on those dollars because you set up through an indexing strategy. Whole life is going to be mainly fixed, and then universal life is going to have some variability based on what the interest rate environment is. So typically whenever we're looking at these four main types of policies, what we're able to receive the most amount of growth and the most amount of benefit from is setting up with the properly structured IUL over the whole life. Even though whole life can work, I'm more on the mindset of saying I want to have more flexibility for my clients. And this is really set up for the clients that just want to try to grow their accounts, but also have that safety aspect, with these sorts of IULs or these properly structured IUL accounts. So what are the major problems with IUL accounts? And the first problem is how they're set up. Majority of the times they're set up the wrong way. And majority of the times they're set up where you have so much money is getting dumped towards that death benefit aspect, and you have high death benefits because when you have a higher death benefit and a higher insurance, it's going to have a higher cost. So when you have that higher cost, that means it gives a higher commission to the agent that's trying to sell these sorts of policies. So with that in mind, you should have the death benefit as small as possible, and it should be some weird number. So like if somebody's trying to hoard in $10,000 a year into an IUL plan, and you see your illustrations coming back at exactly $1 million even, it shouldn't look anything like that. It should be some weird number. It could be like 633,567. Whatever comes back when somebody's programming it the correct way, you know that it's set up for non-MEC limits, but you're trying to hoard away the most amount of dollars on that off of that assumptive, I'm going to be placing away, or this individual is going to be placing away $10,000 per year, $20,000 per year, $5,000 per year, whatever that case is. So how they're set up typically, or really 9 times out of 10 when they're set up the wrong way, it's because that death benefit is so large. And reason being, that underlying incentive is because the larger death benefit means higher costs, means higher agent commissions. So be mindful of how these things are being structured. The other major problems is, or it comes down to, really the goals. If somebody has a specific goal and they're saying, okay, I want to make sure that when I hit my retirement years, I have some sort of tax-free income coming to me. If they're eligible for Roth IRAs or Roth 401ks, how does that sort of account work? It grows by the contribution somebody's placing into the plan and the rate of return. The contribution, if an individual is placing monies into a Roth IRA, there's going to be some sort of cap on that contribution. And then also you have certain phase-out limits, meaning if an individual makes too much money, they cannot place monies into a Roth IRA account. But if they're eligible for a Roth 401k through their employer, there are no phase-out limitations. So an individual could make a bunch of money where they typically phase out of a Roth IRA, they will not phase out of a Roth 401k. And the inner workings of that is contributions are going into that account, and the rate of return is going to be based on the different investments that they could choose. So it could be positive from the contribution side, positive from the rate of return side, and growing with the power of compound interest on a tax-free basis. So when it comes time for retirement, they could pull their monies out tax-free. The death benefit is only going to be whatever the account balance is. But if somebody's just trying to get to that finish line, get to that point B, and they could utilize a Roth IRA, they could utilize that Roth 401k, well, then they probably should not be doing the whole hop, skip, and a jump of leveraging their dollars towards an IUL plan. Because with an IUL plan, the death benefit should really be least importance. The major goal should be trying to hoard these dollars in there to have that death benefit as low as possible so that it allows your accumulation to grow as large as possible because it's having the least amount of drag on that account. If, let's say, an individual is not offered a Roth 401k, or they're phase out of a Roth IRA, or maybe they want to hoard more dollars towards some sort of tax-free growth strategy, and they've already max contributed into their Roth IRA, that's where they could trickle in dollars into the IUL and create a properly structured IUL plan. So that's more of an individual that wants to put consistent contributions into that plan. Another aspect which could be beneficial, let's say if you have an individual that just keeps saving their dollars and saving their dollars and saving their dollars, and they know that they're not going to be touching it for a long amount of time, or they want to just have that flexibility of it growing tax-free, be able to access their monies before 59 and a half, And then also, if they pass away, at least they're leaving some favorable death benefit to beneficiaries. They could utilize those dollars, those lump sum dollars, they could break it up into different intervals, into like a 4-pay or a 5-pay or 7-pay, and make sure that's trickling into these policies. So it's paying off that cost of insurance as early as possible. So you're maxing out the amount of accumulation within that sort of plan. So that's obviously when the goal does match up, but typically what happens is an individual is promised all these great things. Okay, if you go and you place your money into an IUL plan, you could place your dollars in there, you could borrow from the policy after a couple of years, and then you could use it to purchase a car and purchase a house and all this other, excuse my language, bullshit. That's where the problems lie. And what's happening is you're not allowing your growth to fester in there. You're not allowing that longer time frame to pay down that cost of insurance. These sorts of plans are front-end loaded. Regardless of however well you set up, you properly structure it, it's front-end loaded. What do I mean by front-end loaded? Well, if we think about that net amount at risk concept, where is the risk the largest to the insurance company? Is it in the beginning or after an individual's in the policy for 20 years? And it's in the beginning, because in that example, even if somebody's puts $1,000 into a plan and that has $100,000 of a death benefit on there, if this person gets hit by a bus after they pay one premium payment, $100,000 is off of the insurance company's books and has to go get paid over to beneficiaries. If, let's say, this individual is contributing, and they're doing that for 20 years, 30 years, whatever that case is, and now they have a majority of it is set up in a bunch of cash value, and all that cost of insurance and all that risk has dwindled down, that cost of insurance could be minimal the longer and longer that you're in that policy and allow your cash value to accumulate that much further. So that's the other aspect as well, is you want to give it some time. You have to give it some time. Usually I like to see when an individual's about 10, 15, 20, 25 plus years out, where they're saying, okay, I want to place some dollars into some sort of savings component, some sort of asset, know that it's kind of out of sight, out of mind. It's accumulating. If I want to pull out some monies after 10 years, 15 years, 20 years, I could do that. You could set up structured strategies of actual withdrawal strategies to pull out those tax-free monies, or you can just kind of leave it in there, allow it to fester. And then when you start hitting that retirement age, you have your 401k accounts, you have your IRA accounts, you have your Roth IRAs, you have your non-qualified accounts, and then you also have your cash value policies that you could utilize, all as basically turning on these little spigots for income or for growth or for just some little ancillary need, while still having that death benefit protection. Think of it like that umbrella over your head with these sorts of plans, as really that tertiary benefit, that death benefit. And the last major negative is when an individual is trying to fund these dollars with minimum amounts, because there's always going to be some sort of minimum death benefit there, and each death benefit has a per thousand cost of insurance. So if you're saying, okay, I saw this great thing that I could grow my monies tax-free, pull my monies out tax-free, and I want to go and put $50 a month into one of these plans. Well, if you're putting $50 a month into there, it's only going to be $600 total per year that you're placing into that account. There's many times that someone says, oh, well, I saw this video, and they're saying if I go and I place dollars in there, that I'm going to be able to borrow hundreds of thousands of dollars from this account within a couple of years. And the math doesn't add up. So if you're looking to place these dollars in there, you have to make sure that you're actually placing, a decent amount of money into these accounts. So whether that's $500 a month, $1,000 a month, $1,500, it has to make mathematical sense. And that doesn't mean that, you're going and you're taking your last dollar and you're trying to throw it into this account for some sort of savings component. You want to make sure it's after all your expenses. These are meant for your savings, for your ancillary dollars, mainly just meant up for your retirement type accumulation monies. So what I mean by that is, let's say if an individual has access to a 401k account and they make $100,000 in a given year. And let's say that the 401k account is giving them a match of 5%. If they put $5,000 into their 401k account, their company, their employer is also matching them $5,000 in that example. So if we think of that bucket, the contribution of $10,000 is going into their account, and you have a rate of return that's coming back based on the different investments that they choose. Maybe they go, and because they're underneath that phase-out limit, they're also placing an extra, let's say, $6,000 into a Roth IRA, which is $500 per month. Well, the monies are being contributed into this account, and then the rate of return is based on the different investments that they could choose. So these are additional dollars. So with this sort of concept, these individuals are already putting $11,000 per year into some sort of retirement accounts or some sort of savings component. If let's say their expenses are, close to $90,000 and they're only making $100,000 net after taxes, they're only really netting that $10,000 spread. It doesn't make sense for them to try to now hoard more dollars if their expenses are already too high and that difference, that spread is too large. This is more meant for the individual. Let's say if you have a couple that's making $200,000 and their expenses are $90,000, and they're saying, okay, after all of our different expenses, we understand that we're max funding our 401k. We're getting the most amount of matching money. We're trying to place monies into Roth IRA accounts. We're trying to max fund those. And now we're placing X amount of dollars towards our emergency need, towards our savings, but that just keeps, accumulating. We want to go and utilize another component, another bucket. That's where they could go and look underneath the hood and say, okay, what dollar amount can I utilize for an IUL? Because you don't have those phase-out limitations, you don't have 59.5 rules, and ultimately you can have max contributions to this account. So you could be putting away 10, 20,000 into these sorts of accounts and making sure that they're structured properly. And you're saying these are set aside, that these are monies that I know I'm never going to have an expense over that standpoint, that I'm being consistent with my money, I'm being consistent with the contributions, and then I know that I'm going to utilize this account later on, as it pertains to what my retirement goal is. Another example when these can be beneficial is for the individual that's, let's say, is not getting any sort of employer match, and they also make too much monies where they cannot hoard their monies into a Roth IRA account. They're basically phased out of it. And they're saying, okay, well, I've just been saving money. I've been placing money into non-qualified brokerage accounts. I've been trying to get that tax benefit from my 401k through work, but I have limited investment options with my 401k. I'm not getting a match. So what's the real incentive of doing that? And I understand the power of taxes, and I understand how to accumulate dollars properly. So this is where, and I've mentioned this in other videos as well, is whenever someone's trying to accumulate their dollars, whether they're 10, 15, 20, even as close to 5, 7 years out, they always want to make sure that they're taking these 4 main steps. How can I place monies aside to be the most tax effective, tax efficient? Meaning that my monies are growing tax free, and when it comes time to pull my monies out, I could pull my monies out tax free. If you're taking money from an account that's fully taxable, and you're taking $100,000 per year, and you're sitting in a 20% tax bracket, you're only netting, for simplistic purposes, $80,000. As opposed to if you're taking monies, let's say $90,000 from a tax-free bucket, that money, even if you're in a 20% tax bracket, is going to give you $90,000. So even though on the surface, the $90,000 look less than $100,000, it's netting you more dollars. Pretty self-explanatory. Also, when you fast forward and let's say you're hitting your retirement years, individuals typically are receiving Social Security income. If you receive Social Security income and then you're also taking income from IULs or cash value plans that are tax-free, it does not get incorporated into your provisional income calculation, as opposed to if you're taking it from qualified accounts, IRA accounts, or you're making other dollars. So what that means is your Social Security can be taxed at a lesser amount or not be taxed at all if you're structuring out your tax planning the correct way and making sure that you're turning on your spigots the correct way, meaning that you're going to be able to hoard more or net more Social Security dollars, more Social Security income, as opposed to if you just keep taking it from these tax deferred accounts, that could obviously increase the provisional income and then increase the amount of taxation on your Social Security. The I stands for some sort of inflationary hedge. So the reason why I like indexed universal life is because the indexing strategies typically can beat out the pace of inflation. And that's where why they utilize investments in general, because if you look at the stock market and all different types of investments, it's all about trying to grow, trying to have some sort of rate of return on your money that's going to beat out the pace of inflation, meaning your purchasing power. A gallon of gas, a gallon of milk. If you look at the structuring of that, of how expensive it has increased from the last 10, 20, 30 years, you'll notice that inflationary rate basically puts a negative towards any sort of savings component. So you want to beat out that pace of inflation. The other aspect is the market hedge. So whenever you have volatility of markets increasing or growth onto an account, but then you have a large loss, that could mess with your overall rate of return with your accounts. So what I like about the IUL accounts, when you're setting them up and they're properly structured, And there's a few main components that I'm going to cover off of what you should be looking at if you are interested in an IUL policy. But for the main components is that 0% floor whenever the market index that's linked to it comes back negative. So like I mentioned before, that bucket, you have the contributions. If you're properly structuring it out, you have the least amount of expenses that are being placed into this plan. So that's adding positives. And then this rate of return could either be positive or it could be 0% with IULs. With whole life, it's going to be more fixed. But the IULs can give you a much higher potential rate of return. And then also you have better flexibility than a whole life insurance plan. But really that market protection could do wonders, especially if you're saying, okay, I have these amount of dollars that are set up for purely growth that's going to have the ebbs and flows in the market. I want to have another safe haven, another type of safety account that's just growing consistently and then also giving me those tax benefits. And then lastly, the expense standpoint. Like I mentioned before, you want to make sure that you have a longer time horizon because the longer that you're in these plans, the more beneficial it can be for you, the least amount of expenses. And you could have something that if you're in a plan and it's properly structured 10, 15, 20 years, be significantly cheaper than a traditional type of account, like a brokerage account. If you're leveraging advisor and you have advisory fees, different expense ratios on there, a different taxation, all of that could basically drain or put a drag on the growth of your account. So when you properly structure it, you could utilize the acronym of time for a type of accumulation process to set them up with the correct IUL plans. And lastly, there's 7 main areas that you want to make sure you're maximizing if you are interested in an IUL plan. And first off, you want to make sure that you're going with the correct advisor. One of the things with my company, with the Fosse Financial Group and Retire Sharp, by watching these videos, is we have an entire department that's scheduled towards IULs or towards max funded cash value plans. It's taken us many years to perfect this process, and we make sure to go through, to scale through all of the top carriers to make sure that if you're placing your dollars in there, it's being maximized the best possible way based on your state, based on your age, based on your time horizon. Or we would tell you, this is not something that you should do. I understand you assume this process was going to give you X, Y, Z, but in reality, it's going to hurt you. Why not leverage your other accounts and put you in a much better mathematical position? So you want to make sure that it's the correct advisory group, not just some advisor that got their life insurance license and now is trying to peddle in a life insurance product. Or you might see some of these multi-level marketing schemes where an individual's playing into a system and they're telling them, and it's not necessarily their fault, they're being trained the wrong way to say everything should go into an IUL, everything should go into a life insurance policy, regardless of whatever that prospect is telling them. And so that's where there's ultimately a problem. So the number one thing is make sure that you're finding the correct advisory group, the correct advisor to structure these sorts of plans. Number 2 is you want to also find the best company. So really based on your state and based on what the offerings are, you might have one company that could result in thousands of more dollars on an income side and then also a cash value accumulation side than other companies. You have maybe 110 different offers on average. Out of those, there's only about 2 to 3 companies that I like to leverage with these sorts of accounts, while the rest of them are complete shit. It's mainly beneficial for the company because you have so many fees that are associated with these sorts of accounts and so many limitations when it comes to pulling out these dollars, or such low cap limits on these sorts of accounts. So that's where you have to be very careful. You want to make sure you're choosing the right company. Step number 3 is you want to make sure you're utilizing the correct product. So do you want to use a whole life product, a universal life product, an index universal life product, a variable universal life, a guaranteed universal life, a guaranteed index universal life? There's a whole multitude of different product lines out there. Which one is going to be best for your situation? Then you also have variations of those IULs out there. So you want to make sure everything is pinpointed exactly to your age, to your goal, so that everything fits like a perfect puzzle piece if you're trying to leverage this component. The 4th aspect is going to be the different indexes, that are available. So you might have some indexes that are only set up with S&P 500 with a cap of 6%, versus you might have other indexes that have S&P 500 with a cap of 12%. Well, obviously the cap of 12% is going to be significantly higher whenever the S&P goes up than the one that has the cap of 6%. Also, you have uncapped indexes. So some really neat ones that have volatility control indices that might have 150% participation rates, meaning that if the index gains 10%, you're getting 15%. If the index goes down to comes back negative, you're going to gain 0%. So also the indexes play a crucial role there. How they're structured is probably the most important thing, that's step number 5. You want to make sure that it's set up with minimum death benefit, max cash value, and it's teetered exactly however long you're looking to leverage this sort of component. The 6th related concept is make sure that it's funded correctly. Like I mentioned before, you don't want to minimally fund these things because then you're just going to be paying for a boatload of cost of insurance, and it's not going to be beneficial. You're going to be one of those cases where saying, oh, I thought that I was promised X, Y, Z, and then after I looked at my policy after spending thousands of dollars into it after a few years, I realized that's not the case. And then lastly, you want to make sure that the implementation is there, that how you're setting these up, how you're pulling the monies out from the form of tax-free money. You could take it in the form of loans. You could take it in the form of taking out withdrawals. So you have something called FIFO, first in, first out. The amount of monies that you've accumulated, that you've contributed into the plan are coming out tax-free first, and then you're dipping into the investment part of it, the growth within the account. So it's known as General Accounting Principles, FIFO. Or does it make more sense to leverage the loan options? And usually the loan options are crucial with these sorts of accounts. So you want to make sure that you have aspects of variable loan options, index loan options, fixed or wash loan options. So as opposed to just, an account that looks really good on the surface, but then when it comes time to actually pull monies from it, you only have one fixed loan option available to you. So it's really just the implementation of everything from start to finish, and to see whether or not it could be beneficial for your position. So in closing, if you're interested in having a conversation, obviously there's different ways on how you could do it yourself. But if you're interested in having a conversation and you want to try to see if this might be beneficial for you, feel free to give our 1-800 number a call. It's 1-800-566-1002. Make sure to reference this video and we'll have the correct advisor speak with you. One of the things that makes us unique is we have a trademark process. So rather than just say, okay, let's go and just set up an account randomly, we want to make sure that there's some meaning to it. First off, we want to see what your retirement dream is, what ultimately your goals are, and really dissect what your goals are. Seeing what your current situation is, what your current assets are, what you currently have available, whether or not what you're doing right now will get you to that destination successfully, or if there's specific tweaks to make, such as adding in an IUL account, or how to make sure you're hoarding specific dollars into an IUL account, putting the smallest amount of dollars and only as much as necessary to accomplish your specific goal. So we have that trademark process called the Retirement Diet Plan. We try to focus in on distribution, income planning, investment growth planning, estate planning, which ultimately the death benefit obviously could help out from estate planning purposes, and then tax planning, tax-free growth, tax-free income, tax-free death benefit. So we try to encompass and make sure that you're not just creating portfolios, that you're actually creating an overall plan and everything makes sense. I want to thank you very much for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.